Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. So on Friday, we had a bit of a market recovery. The S&P up half a percentage point, the NASDAQ 0.3%, and the Dow 0.4%. Let's take a look at the different sectors. Leading the market Friday were utilities, real estate, defensives, and healthcare. So a lot of defensive rotation out of the risk on assets into the risk off sectors of the market. In terms of the weekly performance, we had tech leading alongside defensives, healthcare, and energy and basic materials. Lagging were utilities, real estate, cyclicals, industrials, and it's a bit of a mixed bag on the weekly chart. And I guess that really explains how we didn't move anywhere on the week. We basically opened, let's see here, 390, closed 395. So basically flat to slightly up on the week. Now, if we take a look at the stock market map, again, Friday led by big cap tech acting as defensives, acting as a safety trade alongside the more traditional consumer staples and healthcare, as well as real estate and utilities. All of these are now considered defensive assets. And we're seeing that rotation into defensives after that financial debacle and that the SVB collapse and all of those bank runs and all of that financial instability in the US as well as in Europe with Credit Suisse. Now let's jump into the daily chart for the S&P 500, and clearly right off the bat we are trading within this bear flag formation, and we had this break down below the flag Thursday, then we recovered Friday, so that's quite interesting. We're still trading between the 50-day moving average, this green moving average, and the 200-day moving average, this blue moving average. We're still inside of this pocket. The market is very indecisive, doesn't know what it wants to do quite yet. And if we look at this from a volume perspective, notice this, the market has been rallying to the upside on declining volume, so it doesn't inspire a lot of confidence. The bulls do have some things going for them. They had this bounce above the bear market trend line. We had this decisive break, then we recovered, and then we held the bear market trend line so far. And if we go and analyze these candlesticks, what you will notice is that we had very decisive moves to the downside, big red candle, and then a bottoming candle on Monday after the Fed, FDIC, and the Treasury stepped in to save the depositors of the SVB bank run. Then we had a recovery, and if you notice, every single candle after the bottom on Monday was green until we recovered the 200-day moving average. Then we had a bit of a retracement, then we rallied again, took out the 200-day, the 9-day, the 5-day, the 20-day moving average. Then we rejected the 50-day moving average on the day of the Fed meeting, had this decisive move to the downside, followed by an indecision candle and a potential bottoming candle with a full-bodied green candle and a rejection to the downside, indicating that the price was rejected to the downside, recovered, and closed near the highs of the days. So we went from fully bearish, full-bodied red candle, indecision candle, to a bottoming candle with a rejection below the prior lows. So overall here, guys, the candles are a bit conflicting, right? Decisive break below the 200-day, recovery, retracement, rejection at the 50-day, and we're now residing in this pocket of indecision. What led this entire recovery was the NASDAQ. If you notice, the NASDAQ bottomed on March 13th, then it rallied, took out this prior resistance line, and it has now retested and retraced back all the way to the prior highs, rejected once this massive rejection candle with a long wick to the upside, massive rejection of price to the upside. Then we closed near the lows of the days, or at the lows of the days. Then we had this a small indecision candle, and it was an inside candle, right? It traded inside the range of the prior candle, right? Then we had another candle that is looking like a potential bottoming candle, narrow body, rejection to the downside, closed near the highs of the day. So it went from bearish, decisively bearish, to indecisive, to potentially bullish. But all of it has been happening again on declining volume. Look at this volume declining. Now, not only has the volume been declining, but the red bars have been significantly higher volume than the green bars. Again, does not inspire a lot of confidence. If we take a look at the Dow Jones continue to be significantly weaker than the rest of the market. We've been trading within this bear flag formation, and we've been trading down since putting in that double top formation. And a full measured move on this double top actually takes us all the way down to 310. So we're not quite there yet. We haven't completely fulfilled the full measured move, and I still remain significantly more bearish on the Dow versus the NASDAQ and the S&P. It continued to underperform the rest of the indices, and it hasn't yet quite reached the full measured move to the downside. Now I want to go back to the 2-hour chart for the S&P 500. Again, perfect trading within this bear flag formation until we closed below it on the 2-hour chart on Friday. Then we recovered the rest of the day. So this potentially could be a spike and a cup bottoming formation right on these smaller time frames. But we do need the PPO to begin moving back up and cross over to form a bullish crossover. But again, that could still end up topping here, forming a double top with a bearish divergence, right? Something that looks like this. That is still possible as long as we do not retest this low back in March. This does not seem to be an appetizing entry for the bulls, in my opinion, in the S&P 500. What the bulls do have on their side, though, is this bullish crossover on the daily chart, and this recovery and this rejection of the prior bear market trend line. We have recovered above it, but what I am watching is this. Usually what happens, guys, after we put in a bullish crossover on the PPO, after a prolonged downtrend, is that we do tend to see an undercut, a double bottom that undercuts this prior low and forms a bullish divergence. This is an example back in October. Look at this bullish crossover right here. On October 4th, we had this bullish crossover. Then we had this double bottom form. We retraced back, took out this prior low, formed a double bottom with a higher low on the PPO. Here's another example, guys. We had this very decisive close and this bullish crossover on the PPO. Then we had this retracement back, formed a lower low and a double bottom on the PPO. Another example is here, guys. Look at this decisive close and bullish crossover, yet we had this retracement back, a double bottom, higher low on the PPO here, and lower low on the price action. That did form a double bottom with a bullish crossover, and the market rallied from that point on. Now, we don't always get these double bottoms. For example, the January bottom, we did not have a double bottom. We did not have a bullish divergence. We just crossed up and then we just rallied from that point on. That is still possible. The difference, however, is that in the January bottom, we had the HYG, the smart money, formed this very bullish divergence, this decisive rally in the HYG as the market was still moving sideways. What do we have now? Well, now it's a bit of the opposite. What we have now is, if you notice, guys, in the last trading sessions, the last 3 trading sessions, the HYG, the smart money, has been making lower lows. It has been closing lower each single day. We had this close March 22nd. We closed lower the day after. We closed lower on Friday. In contrast, the S&P has been closing higher each day. This is a bearish divergence, not a bullish divergence. What you'd like to see for a bullish divergence is that for the S&P to make a lower low, go back down here, form a double bottom, and the HYG to rally from this point on, make a higher low. That would be a bullish divergence. We're not quite there yet. And these divergences, guys, have been working fairly well. If you notice, The HYG made a higher low here versus the S&P here, and that was one of the hints that allowed us to catch this counter trend rally and trade it to the upside. And if you notice, the market did rally for 3 consecutive days following that bullish divergence. There are many examples here, guys, including this example. The S&P made a lower low while the HYG made a higher low. It resolved to the upside. This was a bullish divergence. Another example is here near the September bottom. The S&P was making lower lows. The HYG was making higher lows. Again, bullish divergence, and we rallied. Another example is here in this counter trend rally in September. Higher low on the HYG, lower low on the S&P, and we rallied. We're not quite there yet. And if you notice, if I extend this prior support line, now a resistance line, the HYG has rejected this line consecutively, 3 consecutive days, and closed down every single day since that rejection. So again, smart money not buying this rally quite yet as aggressively as you'd like to see. Now let's take a look at my 65-minute chart. This is one of my newer charts that I started to share with the trading community about a month ago, and I've been using this chart to pinpoint key pivot points, support levels, and resistance levels, as well as breakouts. And it's been working fairly well for us. In fact, I've only executed 5 trades in March, 5 swing/day trades in March, and I'm up about 105% since the beginning of the month on those 5 consecutive trades using this exact hourly chart. By the way, guys, this is the trading community. I post all of my trades in real time in my trades right here. I post all of my charts, all of the charts that you see in the YouTube channel. You'll have a live link to every chart where I point out support levels, resistance levels, etc., including this hourly chart. Here in my charts, I also post my weekly watch list and weekly expected move on more than a dozen different tickers, and a lot of trading resources and learning resources, including my entire list of every single indicator that I use and how I use it here, right here, and my trade setups, the best trade setups that I find, I share here, my investment ideas, and my daily live analysis. Again, guys, if you want to support me, if you want to support the channel, you can join the trading community through our Patreon page. Now, on the hourly chart, we are beginning to see a potential crossover on the stochastic. We are trading now above the slow, fast, and the medium-term moving averages here on the hourly chart. In terms of a resistance level, again, this resistance line that has acted as significant resistance really since the February top, resistance once, twice, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times. So this is a significant resistance line that will likely act as resistance once again, and that would be around 399.5 by Monday. In terms of support, that would be back down here at these prior lows, guys. That would be support in my opinion. And if I take the full measured move after we broke below this bear flag, the full measured move would end up being around 382, so pretty close to this prior support line, pretty close to this prior bottom, and that would again favor that double bottom thesis. So potentially we could see something that looks like this, a rally, rejection, double bottom, and that would probably be a more solid medium-term bottom from which we could see 2 to 6 week counter trend rally to the upside, depending on what the earnings season brings. Again, guys, if you want to have access to this chart, a live version of this chart that I update every single day, intraday, go and check out our Patreon page to join our legendary trading community. Now let's take a look at the VIX. The VIX tends to, again, favor a potential short-term rally here, again, to that 399.5 resistance level. We had this bottoming candle on the VIX exactly at that 20 level that I pointed out a day prior. So that was a so I'm pretty happy with that call. We got that exact retracement back to the 20s. We had a bottoming candle, a candle with a very long rejection tail, a close near the highs of the day, and then we had follow through the day after. Then we rejected once and twice, and we closed near the lows of the day on Friday in terms of the VIX. If we take a look at the smaller time frames, the 1 hour chart, we are back at this level of support that acted as support here. So we'll see if it acts as support. If it doesn't, the VIX will likely go all the way back down to 20 and potentially even lower than that. If I take a look at the daily chart, there's this potential support line that has formed since that low on the VIX on February the 2nd after the market put in that top. This could potentially now act as support around the 19.4 level or the 19 level sometime in the next few weeks. So again, a lot of contradicting information here, guys, between the smart money being bearish, the smaller time frames on the S&P 500 potentially being bullish, between the Dow Jones not realizing the full measured move to the downside yet, and now the VIX being bearish on the daily chart at least, but then being potentially bullish on the smaller time frames, including the 10-minute chart, where it's now potentially forming a double bottom formation or a bottoming wedge formation that could break out to the upside again. That could potentially make a slightly lower high versus these prior highs as the S&P makes a lower low. That usually marks a bottom, guys. We haven't seen that yet. We haven't seen a bullish divergence quite yet. So I'm still waiting for that bullish divergence to develop. If it's going to develop at all, it needs to develop pretty quickly here. And here's what I'm talking about, guys. If you notice, in S&P 500 bottoms, the S&P is down below, guys. This is the blue and black chart. This is the S&P. In market bottoms, the VIX tends to form this double top formation, lower high on the second top, lower low on the S&P, and that usually marks a bottom. There's another example here, a double top on the VIX, slightly lower high, lower low on the S&P, double bottom, and bullish divergence. Another example, again, includes this period back in early March of last year, double top here, guys, and a lower low on the S&P versus the prior low in January. Again, bullish divergence, lower low here, lower high here, and that again marked a bottom. So we would need to see the S&P potentially make an equal low or an even lower low, and the VIX do something that looks like this: double top, lower high on the VIX and lower low on the S&P, and that would mark a bottom in my opinion. If we take a look at the TLT long-term treasuries, I also track this chart to find bullish and bearish divergences. If you notice, when we put in that February 2nd top, the S&P was rallying while the TLT was moving sideways. Then it put in this double top. We had this reversal, and it marked the top in the S&P as well as the treasuries. Then we had this significant bearish divergence where the TLT was selling down significantly and the S&P was flagging. And that again marks another bearish divergence, and the market declined significantly from that point on. So far, we're seeing another bearish divergence where the TLT has been actually moving down, now potentially more making a double top, and the S&P has been moving up. Again, a bearish divergence that could lead to that double bottom formation that I talked about. Overall, however, from a longer term point of view, TLT is likely going to trade in a range right up until the Fed ends the rate hiking cycle. The Fed did hint at the end of the cycle coming in either at the next meeting or the meeting after. So we're waiting for a potentially one final rate hike or two final rate hikes, and that would be it. So we're getting very close to the end of the rate hiking cycle, and that tends to favor long-term treasuries to the upside. If we take a look at gold, again, gold has been rallying in anticipation of inflation remaining high. That's number one. And number two, the Fed potentially, again, ending those rate hikes as early as the next meeting in early May. We did move above both of my upside targets. I did enter gold here at this breakout candle, and I'm still holding. I'm holding shares, not options. I'm still holding gold. And in terms of resistance, I think we'll rally all the way up to these prior highs at 190 plus before really gold can find something like a pullback back here, and it continues to rally from that point on. Now let's take a look at natural gas, everybody, and natural gas looks like it's forming a double bottom formation. If you notice here, guys, we had a lower weekly close on natural gas versus February, and then on the RSI we have a higher low. So we're getting a bit of a bullish divergence here between the price action and the RSI. On the daily chart, again, similar look here. I do want to see natural gas go down slightly more, even undercut this prior low to form a bullish divergence where the RSI tags this prior support line. The PPO makes a slightly higher low here, and then we move back up. That would be my preferred setup for natural gas to move back to the upside and form complete this double bottom formation. Now let's take a look at the dollar. The dollar did top exactly at our full measured move here, guys. I did share this full measured move with the trading community all the way back in February. So we did top exactly at the top of the full measured move. Then we began to move down. We had this bearish crossover as the S&P actually found a local bottom here on March 13th. Now the dollar is trying to find some buyers here. We could potentially see something that looks like a head and shoulders formation. So slightly higher on the dollar, the S&P potentially makes a double bottom. The dollar moves slightly up and then continues to move back down. The dollar will likely not find support all the way back to this low of 97. Yes, 97, back to this trading range of March of 2022. Now, as we get closer and closer to the end of the Fed rate hiking cycle, the dollar will see more and more pressure to the downside as gold rallies more to the upside. Now let's take a look at the 10-year yield. The 10-year yield, look at this PPO pointing straight down. The histogram is red and even more red. So the 10-year yield looks pretty weak here, especially as more and more bond traders, bond investors begin to pile into the 10-year treasury note, expecting a Fed pivot around this summer that will send treasuries higher and treasury yields significantly lower. I think these lows are toast now, pretty much toast. We have taken out these prior lows on the PPO, creating this bearish divergence, and we will likely not find support all the way back down to 2.5% on the 10-year yield. This is a chart of the 10-year yield divided by the 2-year yield up top, and the S&P 500 is down below in blue and black. What I do want to point out is that after every single yield curve inversion, the market had a massive crash about 12 to 18 months later due to recession. Every single recession in the last 100 years has been preceded by an inversion of the yield curve, specifically the 10 and 2. When does most of the decline come? Well, let's take a look at the 2000 to 2003 bear market and recession. If you notice, we had the inversion begin here. The market ended up topping about, about 6 to 7 months later here. The yield curve exited inversion right here in the month of January 2001. We began to steepen significantly, and that's when the majority of the decline came. If we take a look at the 2008 recession and bear market, we had a pretty similar look here, guys. We had a brief inversion in February of 2006. Then we had that deeper inversion in 2007. The market ended up topping about 6 months later. When we exited the inversion, that's pretty much when the market topped right here. And then we had that massive decline in the stock market, 58% from the top to the bottom. More than half of the value of the S&P wiped out. Now let's take a look at this, guys. We had a small yield curve inversion, and believe it or not, it predicted the recession that would come from the pandemic. Look at this. Then we had that pandemic recession that did not last long because of the Fed intervention, QE infinity, printing money to the moon. Then we had this yield curve inversion beginning in pretty much in earnest in the middle of last year in the summer, and we're now beginning to steepen again. And once we exit the yield curve inversion, once we get that steepening commence in earnest, that's going to be when the S&P finds the majority of the decline as we get deeper and deeper into recession. I want to take a look at gold divided by the S&P. This is a relative chart. This is a ratio chart. And what I want to point out is that when gold begins to underperform the S&P and the PPO crosses down, that usually marks prolonged counter trend rallies in the S&P 500. We are not there quite yet. I'm still waiting for a cross down here where the S&P could potentially begin to outperform gold. We're not quite there yet. This suggests more downside for the S&P, and again adds to those mixed signals, right? We have the candlesticks potentially pointing to some short-term upside here, but then we have this ratio chart as well as the VIX, the TLT, high yield bonds, all offering conflicting information. Not an ideal long entry, just in my opinion. I would prefer to see, again, a pullback, that double bottom that I talked about. Now let's take a look at the put to call ratio. This is a key chart that I use to pretty much track every market bottom and top. And this is my own indicator. This is a proprietary indicator for Money Time Machine. And what I'm looking for now, guys, is a lower high on the 5-day moving average for the PC put to call ratio as the S&P makes a lower low, forming a divergence and a double bottom. Now, these divergences, guys, did mark pretty much every market bottom. If we take a look at the market bottom in October, look at this double bottom, lower low on the price action on the S&P, lower high on the put to call ratio, suggesting that more and more bears are exiting their short positions and selling those puts and buying calls, forming a lower high here on the put to call ratio. And again, that did mark the bottom. If we take a look at this as well, guys, here, the May bottom, look at this, slightly a lower high here, slightly lower low on the S&P. Then we had that counter trend rally, and that did mark a bottom in the market. If we take a look at something else as well here, guys, between January and March of last year, we did have this, look at this, slightly lower high, lower low on a closing basis versus here. And that again marked a bottom, and then we had that counter trend rally. So that's what I'm looking for right now. I'm looking for the put to call ratio to move slightly up. I'm looking for the S&P to pull back slightly more and form that double bottom and that bullish divergence on all sorts of indicators, including the PPO, the RSI, the PC put to call ratio, the VIX, all sorts of indicators would trigger a buy signal if that ends up happening. One of the best indicators ever to really find out if we're in a uptrend or a downtrend is the summation index. Pretty much every crossover on this summation index has marked the beginning of a counter trend rally and the end of that rally and the beginning of a sell-off. Again, crossover, beginning of a rally, cross down, beginning of a sell-off. We haven't yet gotten a crossover on the summation index, again, adding more and more to those conflicting data points. And that's usually what happens, guys, near bottoms, not at bottoms, but near bottoms. You get a lot of conflicting information, and then you get that final flush down, and that final flush down seals the deal. You get a crossover up on the summation index. You get the histogram moving back up into green. You get the VIX making a lower high. You get that PC put to call ratio making a lower high. All of those will come together at the bottom, and that will be a buy signal. Not quite there yet. Again, not quite there yet, as the summation index suggests. If we take a look at breadth, this is the 50-day breadth, continues to be very, very weak here, guys. Hasn't crossed over quite yet. And this is, again, one of those beautiful signals that marks market bottoms. Look at this signal rally, bottom, signal rally. We're not quite there yet, but we might be getting closer and closer to finding a bottom here soon, a local bottom. If we take a look at the BP-SPX, again, I'm looking for a potential bullish divergence here. For example, what we had back in May, double bottom on the S&P, lower low, double bottom on the BP-SPX, lower high, higher low. Then we had a rally. Same thing pretty much here, guys, in October, and pretty much the same thing here as we've been moving sideways. We had this rally to the upside, higher lows, higher highs, and then we had that rally. We're not quite there yet again. And in terms of economic events next week, not a lot going on. The most important is going to be the PC, personal consumption expenditures figure, the preferred inflation figure by the Fed. That's going to come out on Friday. So the market will largely trade based on technicals as well as news events, global news events right up until Friday. So it's anybody's game really, not clear for the bulls or the bears. What is clear is that we are potentially now beginning to form a local bottom. The signals are beginning to turn, but we're not quite there at that sweet spot for a buying opportunity, but that might be coming as early as next week for, once again, a potential counter trend rally that takes the NASDAQ back up to this full measured move, somewhere in this red box between 333 and 343. And that will, in my opinion, mark a major top in the stock market, and then we could begin to see significant downside from that point on. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.